Everyone. My name is Angeline Vong. I am the co-founder and chief product officer of Cherub. Cherub is a platform that focuses on connecting angel investors and strategic advisors with, really great high impact startups based off of their specific investment interests. Kind of think dating app like mechanics. And so we've been around. The actual live product has been around just a little over a year. And since then, we've helped connect founders to over $4.5 million in strategic investments and advisory capital. So, really excited. I was introduced to Alisha Griffey, who is a prolific angel investor and also the founder of Daintree Capital, which helps provide debt financing solutions to startups. And I think this whole world of debt financing was something that, quite frankly, I knew nothing about. And so really just wanted to have a conversation with Alisha and, have a kind of a safe space for a lot of founders, I think, who might not be aware of debt financing and their options beyond fundraising or bootstrapping, and ask, the questions that we might be a little afraid to ask, or we just don't even know what to ask. So really excited. Alisha, I'll let you take it over from here.
Thanks so much.
Yeah.
Pleasure to be here and meet some of the folks in your community. I'm Alisha Griffey. I am both an investor, but also come from the startup world. So I'll share a little bit about my background just because hopefully this provides you with some context on why I'm doing what I'm doing and where my experience is, because it's relevant in terms of how it's informed our approach to investing. So I spent a decade in the startup world as an operator. I was CFO and or COO of 3 different companies, mostly in the clean energy space. And I was on the hook to build the financial models and get the fundraising and walk into banks and ask for lines of credit and figure out how we're going to stretch a dollar. And across that decade, I took money from venture capital, from private equity, did like small series, pre-seed rounds, friends and family round, and then, even took a company public. So I had a very broad experience across raising money from a lot of different sources, mostly equity capital. And that experience really informed why I founded Daintree Capital 5 years ago, and also how Daintree approaches investing. Because what I saw was that there were a lot of founders and there were a lot of business models that kept getting overlooked. So I'm sure folks have heard all the same statistics. Less than 2% of venture capital goes to women-led businesses. The numbers are even worse for women of color. It's less than half of 1%. So that to me just meant, wait a second, you either believe women have less than 2% of the best new business ideas, or you believe their businesses are massively undervalued. So you can guess which one of those two I believe. But that idea that there were all these businesses out there that were undervalued was both frustrating to me and also a huge opportunity from an investor standpoint. And then the other thing was I kept seeing these business models that kept getting overlooked, that were more focused on near-term profitability, more focused on sustainable economics. We're not chasing hyper revenue growth, or we're not promising unicorn status in 5 years. They were not, kind of waving all the flashy, balls that get equity investors excited, and those companies would also get overlooked. So it was, as I founded Daintree, I knew I wanted to invest differently, because I wanted to invest in these founders and in these business models that kept getting overlooked. And so that is why Daintree focuses on investing through debt, short-term working capital loans, to companies that have at least 100,000 in revenue, and have strong unit economics. And I just realized this slide is slightly out of date. We've done 6.5 million in loan volumes across about 80 companies. So that is my context in terms of who I am and why I decided to invest through debt. But today, what we're really going to do is we're going to focus on all the different options that are out there, because I think what I learned in my experience being the person in charge of raising the money is that there's all these different sources of capital out there that a lot of people don't know about. And I figured it might be helpful to talk through what some of those sources are, pros and cons of those different sources in order to hopefully help founders think through their options. So this slide here kind of lays things out along the non-dilutive to dilutive spectrum. So you see on the left-hand side, grants. These could be from governments, these could be from foundations, but it's non-dilutive capital that does not become equity. You do not have to sell a portion of your company. Sometimes there's strings attached, sometimes there aren't, but usually it's more kind of administrative strings than anything else. But grants are often overlooked way to raise early stage money in particular. Second, we have debt. Two main kinds of debt. There are lots, but the two main buckets are P&I loans, so principal and interest loans. Think of these as kind of akin to a mortgage in terms of their structure, a specific period of time, a specific monthly payment, part of which covers principal, part of which covers interest. And then there's also these revenue-based loans, and we'll talk more about what those look like, but there's a lot of revenue-based financing that people talk about these days. And it's essentially debt, it's just structured differently in terms of how it is repaid. And then moving a little bit further towards the dilutive side, we've got convertible notes. You both have traditional convertible notes and you have safes. And the reason why these are kind of in the middle is because on paper initially, they look like debt. And then an event happens, you have a priced round, and those notes would convert into equity. So they start out as debt on your balance sheet, and then they turn into equity at a certain moment in time when there is a pricing event. And then lastly, there's equity. And this is what people talk about most of all, right? This is where all the energy is. This is where all the conversation is. This is what when you think of Silicon Valley, you're thinking of, am I doing a friends and family round? Are there angel investors who can invest in my business? Is there crowdfunding opportunities? If I've already got some traction, is there a big venture capital firm I can turn to? When you're even bigger, maybe private equity comes into play. And then a few small percentage of companies actually go all the way into the public markets with an IPO. So this is the spectrum or the landscape, if you will, of options. Non-dilutive, meaning you do not have to give away or sell a portion of your company, so it does not dilute your ownership. That's what's on the left-hand side. And then dilutive, meaning that capital comes in exchange for a percent ownership in your business. So that's the spectrum. Let's talk a little bit about each of these. Now, grants, I will admit, I actually pulled this slide out of the deck because I feel like they are incredibly powerful and can be a great source of capital. But at least the federal grants right now are a bit of a mess. And so I don't want to spend a ton of time on that just because there's a bunch of grants that have kind of gotten pulled from companies recently. But what I would say is put a pin in the idea of grants and 6 months, 12 months, 18 months from now, come back and think about it. Do you have a technology where the National Science Foundation might be willing to support it? Do you have a technology that the Department of Energy would be excited about, or the National Science Foundation, or NIH, or the Department of Education? There's a bunch of startups I know who've gotten significant money from some of those entities. It's just a bit chaotic right now, so it's not a great time to apply. So let's jump in and talk about debt. So as I mentioned, there are kind of these two big buckets of debt: principal and interest, and then revenue-based loans or revenue-based financing. So the example in the middle is what it would look like if you had a principal and interest loan. So if you took out, let's say, a 5-year loan to pay off a piece of equipment, it would probably be a principal and interest loan. You would have fixed monthly payments. Usually it's monthly. It could be every 2 weeks. It could be every week. Usually it's monthly. You would be repaying it over a set period of time, 1 year, 3 years, 5 years. So you know exactly how long it's going to take to pay it off. You have a preset interest rate. You're taking that loan out at 5%, 10%, 20%, but there's some specific interest rate that you are paying attention to. And the key thing to keep in mind on these principal and interest loans is that the interest rate can be misleading. And the reason I say that is because interest rates are usually calculated on an annual basis, but sometimes lenders will talk about them on a different period of time. So they'll get you excited about a 5% loan, and then you read the small print and it's a 5% loan over 60 days. And all of a sudden you realize, wait a second, that's actually a really, really, really expensive loan. That loan is, 6 times as expensive as it sounds because I have to pay that 5% every 60 days. The alternative can be true, whereas you might take out, say, a 15% loan and you repay it over 1 year, but because every month you're paying down the principal, the actual cost of capital for that loan is less than 15%. It'd be like 8%, about half of it. So because your principal shrinks every month, you're not paying 15% of that principal of the initial loan amount evenly. You're paying it down every month. And so the actual cost of capital is about half of the annual rate if it's a 12-month loan. So those are some of the things to just think about in terms of structure of a principal and interest loan. And then we get into revenue-based loans. These are kind of, becoming increasingly popular. And so I think it's important to understand how these are structured. So the way a revenue-based loan works, usually, there are nuances depending on the lender. But usually what happens is you might take out, say, a $10,000 loan. And what they say is, we want you to repay this loan as a percentage of your revenue. Daily, weekly, monthly. Usually the repayment on these revenue-based loans is more frequent than monthly. There's a lot of them through, like if you sell a product on Shopify, there's a lot of things through like Shopify Capital or PayPal Capital. A lot of these are structured as revenue-based loans, and they will just suck out a portion of your revenue before you even see it. And they keep sucking out the agreed upon portion. Say it's 5% of your revenue every day or 5% of your revenue every week. They'll keep doing that until you get to a max. So instead of saying you will repay this over 12 months or you will repay this over 36 months, what they will say is you're going to keep paying me 5% of your revenue every day or every week or every month until you hit X dollar amount. And usually what that is a multiple of the loan amount. So they'll have a cap, a repayment cap, that'll look something like 2x, 3x, sometimes even 4x. So you take out that $10,000 loan and you're going to keep paying 5% of your revenue until you've repaid, if it's a 2x cap, until you hit $20,000. If it's a 3x cap, until you hit $30,000. So these loans can be great because you only are paying when you have revenue. That's the real appeal of these loans. But they can be secretly expensive because if you repay that loan quickly, and let's say you have a 3x cap, and you repay that loan quickly, the implied interest rate is very, very, very high because you're taking that $10,000 loan and you're repaying it up to $30,000. And if you repaid it over 6 months or a year, if you repaid it over a year, that's a 300% loan, right? Interest rate. You repaid a $10,000 loan by giving them back $30,000. That's a 300% loan if you repay it over 12 months. Now, if you repay it over 5 years, that becomes a much more affordable loan, but you're not in control of how fast you repay it. It's just based on your revenues. So it kind of almost creates this disincentive. If your revenues take off, and that means you're repaying it faster than you anticipated, the implied interest rate actually goes up because you're repaying it faster. So that's something to keep an eye on these revenue-based loans. Let me just pause here for a second and see if folks have any questions of the difference between a principal and interest versus a revenue-based loan.
I was going to ask you kind of the scenarios in which would be better for each. It's funny because as you were explaining revenue-based loans, I know a founder who does about 2 million in revenue. It's a consumer product each year. And this person was telling me we are addicted to Shopify loans. Like we are so hooked in it. And they're at this point where it's becoming a problem.
Yeah.
And so I definitely have heard firsthand the appeal and the lure, but also the downside of it. So, like, as a founder going into it, how do you decide like when a revenue-based loan is good versus a principal and interest-based loan? I think that's the first question. The second question is like going from a total newbie perspective, like, how do you even find these people to give you these loans,
Yeah.
especially when you're in like that kind of early traction position?
So if you are selling a product on the web, usually it's through Shopify. They clearly are the market leaders. You don't need to find them, they'll find you. There are going to be a whole lot of um, uh, folks reaching out to you. If you're accepting payments through PayPal, PayPal is going to reach out to you.
Stripe too.
So
We get those Stripe Capital offers as
100%.
well.
Not all of those are revenue based, but a lot of them are. And here's what I would say about when it's helpful. Look, the benefit is they're super fast. You can usually get the money like that. They also are just you can often get or you're often eligible earlier on than you might be from our traditional loan structures. And that's because the risk to Shopify or to PayPal is almost zero because they are sucking the money out before you even see it. So your company has to fully go out of business for them basically not to get their money back because they take the money before you get the money. And so for them, it's a very low risk loan. And for you, it can really hamstring you because all of a sudden they become the first bill paid, whether you like it or not. And all of a sudden you might not have enough cash left for other things. So I hear all the time that people kind of get addicted. They get addicted to the speed of it. They get addicted to the ease of it. And there's a time and a place for it. What I would say is just keep the dollar amount small, make sure you're never getting above, say 5% of your, I guess there's some that are 10. I would say be very careful before you ever sign up for more than 10% of your revenues going to these loans because there's just going to be so little cash coming out of it. You're going to have trouble covering your COGS at some point if you sign up for more of these loans. So I would be very careful about how much you sign up for. But there's a time and a place for them, particularly when you're early stage and particularly if you are not, dollar wise, percent of revenue wise, not doing all that much. Now, what I will say is there's also, a version of this in QuickBooks that people may have seen where they'll do kind of accounts receivable financing as well, where you send an invoice to a customer, they owe you $10,000 and QuickBooks will say, hey, you want the money now? We'll charge you 3% or something and we'll give you the money now. Those are slightly different loan structures. And you have to be careful with those too. It's super appealing. Be like, oh my gosh, that customer usually takes me 60 days to pay me. And if I do this QuickBooks option, I'll get it right away. And that sounds great. And that absolutely may be the right choice for you. But you have to think about that as not a 3% loan, but as a 3% loan over 60 days or whatever the normal time horizon is that customer pays you. It's a 3%, maybe it's a 3% loan over 30 days, right? Because the customer usually pays you in 30 days. That's a pretty darn expensive loan. 3% for 30 days. So, that means basically multiply that 3% times 12 months, and that tells you what the annualized interest rate is. These are pretty expensive loans. So I would say just use them sparingly, but it's not that you shouldn't use them at all. Just use them sparingly.
Super helpful. And then I think the other question, oh, okay. So Sarah is asking what would be considered a great percentage of revenue?
So I would not go above 10. I think if you're down like 5 or lower, then that's great. And what I would say is it needs to be 5 or lower across all the loans. You have to be careful of stacking them, right? Like, oh, I did, one loan here and it's going to be 5%. And then I did another loan, it's going to be 5%. Like if it's from different channels, that's fine because the money coming through PayPal is a different pot of money that you're taking 5% out of versus the money that's coming through Spotify usually. Sometimes there's some weird relationships there. But make sure it's not stacking on top where it's the same pot of money and I've got one person taking 5% out and another person taking 5% out and another person taking 5% out, and suddenly 15% of your revenue is tied up and you never see it. But I'd say if of your total revenue, if you have less than 5% tied up in things like that, that feels like a much more comfortable place to live.
Gotcha. That's super helpful. And then I think going back to the second question, it's like, sounds like we've all probably been approached, everyone on this call, if you have something through Stripe, Shopify, et cetera, modern business, you've probably been presented with the opportunity to take a revenue-based loan. How do you find, principal and interest loans?
Um, so these are somewhat trickier. It depends on what you're looking for. Like there's a bunch of players out there who do equipment financing, and equipment financing is usual principal and interest loans. And so you kind of, can, Google search the big folks, or whoever you buy it from will provide the financing, and it will be a principal and interest structure. There's also principal and interest structures for like walking into your corner bank, or SBA loans. SBA loans are great loans usually. They're principal and interest structure. The trick is just that they're slow. It takes a long time to get one. And usually you have to go through a local bank and you partner with them to do it. So this loan structure tends to be more traditional lenders, corner bank, SBA, et cetera, equipment financing. But then there are some alternative lenders out there like Daintree that more or less use this structure, but then have some caveats that make it different. So for example, and we'll actually get to this, but there's some things you should be looking at. If you're going in signing up for a loan, there's some real things you should be looking at. And we'll talk about some of them, but an example is there a personal guarantee, right? Do I have to personally guarantee this loan? And what that means is if the loan doesn't get repaid, are they going to come take my house? And my house is in my name, or it's in my spouse's name, or it's part of my personal assets. It has nothing to do with the business. But if the business does not pay back this loan, are they going to come after my house? And that's essentially what it means to sign up for a personal guarantee. And so there are lenders out there, a lot of traditional bank lenders walk into any corner bank. If you're a small business, they're going to ask you for a personal guarantee. And that is both to be expected and also super uncomfortable. So there are some alternative lenders out there like Daintree who just don't do personal guarantees. We do unsecured loans, which is very unusual for early stage businesses. And so you just have to kind of look around and understand the terms so that you can really compare them. And we'll talk about some of the other things you should look for when deciding whether or not to do a loan.
And I think before we move on, there's lots of questions here. One thing is often we'll see founders on the platform raising for inventory, just because it's like, I've got $1 million PO in hand from Target and I don't have the money to get the inventory to fulfill that. Do you consider, is inventory financing also part of these P&I loans, or how does that?
So it depends on who you're partnering with. So Kick Further is a common platform used for it, and I've seen them structure things different ways. So it really depends on, you just have to ask the questions. A lot of inventory financing is more principal and interest, but not always. And sometimes they're more kind of hybrid-y, where it's like principal and interest with a big caveat of, if, for something like, or I guess not for inventory, but for like accounts receivable lending, they'll come up with very creative structures for it. But most inventory financing, not all, is principal and interest.
Gotcha. And then the last question from Sarah on this slide were, what are key questions to ask when considering a revenue-based loan? And I would even ask, can you ask questions?
So this is a great segue for our next slide. So let's talk about this. So put a pause in it for 1 second, and then I'm going to go through each of these different kinds of alternate sources of capital, and let's talk about what the questions are you should be asking. So first, with grants. This, grant could be as simple as like, hey, I got a grant from a local pitch event. It can be something along those lines. It basically just means non-dilutive, no strings attached money. But the key questions to ask if you receive a grant is, what is the admin burden associated with taking this grant? Are they, for example, maybe the granting body wants to show the impact that their grants have. And so they want to capture a whole bunch of statistics about your business. How many people did you hire this year? What are your revenues? How much did you grow? Where are you located? You know, all these different questions. And that might be fine. It might be a 20-minute task once a year to fill out a survey. No biggie. You want to give me a $10,000 check and I spend 20 minutes once a year answering a survey on the impact of that grant? Sure, sign me up. That sounds great. Other grants have very cumbersome admin requirements, you know, where they are asking a whole bunch of details and they want you to provide reporting every month and they want you to track this and want you to track that. Usually the higher the dollar amount you're receiving, the more the admin burden. So what I would say is just understand what that admin burden is before you accept the grant. And then the other question I would ask is, what's the timeline for decisions being made? There are a lot of grants out there that are fantastic if you can get them, but understand how long it takes for them to make a decision. Usually there's some winnowing down process. It's like, well, we have, 20,000 people apply. And then in November, we winnow that down to 1,000. And those 1,000 have to come and do a video pitch, for us. And then those 1,000 get winnowed down to 50. And the 50 do in-depth interviews. And then those 50 get winnowed, So understand that process because it could be time consuming or it could just be slow. And so it's important to understand how long the grant timeline is until you will get a decision. So those would be the two things I would ask about grants. Debt, this gets back to the question you asked. So for debt, a couple of things you should pay attention to. Interest rate, both, is it on the surface, they tell you this is a 10% loan. If so, ask what that means, like what's the period of time and what is it annualized, right? So make sure, 100% sure you are clear that it is an interest, or what the interest rate is on an annualized basis. They say 5%, you say that sounds great, but I just want to confirm, is that the annualized interest rate or is that over some other period of time? Because if they come back and say, oh, that's the interest rate for 30 days, that's a completely different interest rate, right? So make sure you understand the actual interest rate annualized. And if it's a revenue-based loan, they're going to say, well, we don't have an interest rate. That's not relevant for us. And they're right, but there is an implied interest rate. So you need to do the math and say, okay, this is a revenue-based loan. It has a 2x cap. So it means I'm going to keep paying some percentage of my revenue on that $10,000 loan until I've repaid $20,000. So that's their situation. That cap is 2x. Okay, what is the implied interest rate? Well, if I repay it over 1 year, the implied interest rate, the math is easy. That's a 100% interest rate, right? If you repay it over 1 year. So how quickly do you think you'll repay it? If the repayment terms are such that it might take you 5 years to repay it, then that implied interest rate is way, way, way lower and may be great. Do the math. Make sure you understand the actual or implied interest rate. So that's thing number one. Thing number two is late fees. So they say the payment is due on the 15th of the month. Okay, well, how do you make payment? And if the payment doesn't arrive till the 16th, what happens? Is it fine? Or do you immediately get hit with a late fee because you're 1 day late? Most loans have a grace period. What they'll say is it's due on the 15th of the month. There's a 10-day grace period. But if we've not received payment 10 calendar days after the due date, then there's going to be a late fee. And here's what the late fee is. It's X dollar amount. It's Y percentage. Understand what the amount of the late fee is and how soon it gets triggered. Is it day 1 of being late or is it day 10 or day 30? So that's really important to understand. Third thing you should understand is cure period. And what that means is if you mess up, do you get a chance to fix it? So let's say you owe $500 every month. That's your debt payment. And something terrible happens in the month of May and you could not make that payment. Try as you could not come up with the $500. The cure period would be something detailed in the loan docs that would explain how you get to fix it, and if there's a period of time where you're allowed to fix it before the loan goes into default. So it might be something like you have 30 days cure period, or you have a 60-day cure period before we declare the loan to be defaulted. So let's say it's due on the 15th of the month. 10 days later, you start accruing late fees if you haven't paid, but you have a 60-day cure period. What that means is, let's say you have one really bad month and some fees hit you, some costs hit you, you just didn't have the cash and you missed your payment, and you were able to pay it, but you paid it 30 days late. What that means is you're going to owe the late fee because you did not pay on time and it was more than 10 days late. But as long as in that 30 days you've now caught back up and you didn't get late again on the next month, then they're not going to put you into default. They're going to say, okay, frustrating that you paid us late, but we got our late fees and you're not in default. You fixed the problem within the cure period. And that cure period is really important. A 30-day cure period, obviously not nearly as good as a 60-day cure period. You want to have as long a cure period as possible before a loan is considered to have been defaulted on.
And what's pretty standard?
I'm not sure there is standard, but I would say somewhere in the 30 to 60 day period. If you could get more than 60 days, that would be great. If it's less than 30 days, that's bad. Fourth thing you should think about, default provisions. So what that means is, if you do default, what happens, right? Do they come and seize property from your company? You sell blue jeans and they're going to now come in and grab all of your blue jeans valued at whatever the amount is of the debt that was defaulted upon. Are they going to come take your house? Are they going to send a collections agency after you? Are they going to take you to court? What happens when there is a default? And obviously you want what happens in the case of default to be as reasonable as possible. Things like, giving you a chance to, reasonably respond, things like being able to, make catch-up payments to basically pull yourself out of default. Anything you can do to have the default provisions in a loan be as reasonable as possible is obviously something you want to look for. And then lastly, hidden fees. This is just, unfortunately, there's a bunch of lenders out there that try and play games, and they'll lure you in with a 5% interest rate, and you'll be like, no, I'm smarter than this. I'm going to ask. I'm going to say 5% over what period of time? And they're like, oh, no, it's 5% annually. Isn't that great? We'll give you $10,000 and it's a 5% annual interest rate. And you're like, this is amazing. This is awesome. Great. Sign me up. And then somewhere in the small print, it says, but there's a $5,000 closing fee, right? So suddenly your $10,000 loan, there's a $5,000 closing fee and a 5% interest rate. And now obviously the implied interest rate just became 55+%. So be really careful to make sure you understand. Ask the question, are there any other fees? I see your interest rate. Are there any other fees? Origination fee, closing fee, financing fee. They call them different things, but definitely ask about the fees. So let me pause here. Any questions about what you should look for when considering debt? If not, we'll go on to the next one. All right, let's go on. So convertible notes, I'm not going to spend a ton of time on this, but this is mostly what people are more familiar with, right? This is how early stage companies typically fund themselves in the early days, maybe before they have revenue. But the key things you want to look out for on a convertible note is understand the maturity date. That it means, I am promising to this investor that we are going to convert this note into equity prior to X date, right? Well, 2 years out is very different than 5 years out. You want to give yourself as much time to do that conversion as possible. So from a founder's perspective, you'd want to make sure that maturity date is, ideally 5 years out, but maybe you can get away at least with 3 years out. You certainly don't want to be signing convertible notes that are like 1-2 years out. It just doesn't give you enough time as a founder to raise a priced round. So pay attention to the maturity date. Pay attention to, and by the way, maturity rate's usually quoted as X number of months from the signing of the document. So it'd be like 36 months, 72 months, et cetera, from the signing of the convertible note. Interest rate. So the difference between a safe note and a convertible note is a safe note doesn't have an interest rate and a convertible note does. So the idea of a convertible note is once you hit that maturity date, so let's say it's 5 years out, you either have converted it to equity or you are repaying the note with interest. That's what a convertible note is. So you want to understand what the interest rate is. Usually it's like 10 to 12%. But you want to understand if 5 years out, you all of a sudden hit that maturity date, you're going to have to do one of three things. You're going to have had a priced round so that it has converted, or you're going to have to repay the note to the investor with interest, or you're going to have to renegotiate the maturity date with that investor. One of those three things. So make sure you understand the interest rate. The reason why safe notes became a thing was because most investors don't do convertible notes because they want interest. Most investors are really gambling on it converting. And so a safe note is just a convertible note without interest. And it basically says, look, we don't ever want to be in the situation where you're paying us interest. We don't care about that. We're not trying to do a loan. We either this note has converted and you guys have been successful, or this note just became worthless, but we're not messing around with this interest rate thing. So that's the main difference between a convertible note and a safe note. Discount rate. So a discount rate is when the conversion happens, what is the discount that the convertible note holder has that basically pays them for taking earlier stage risk. So often it's something like 20%, 25% discount on whatever that priced round is. So discount rate is important. Sometimes now you'll see safe notes without a discount rate because they're kind of implying a low valuation cap does the same thing. Personally, I don't like that because I think valuation caps is a massive guess in the future about the value of a business. And it's really, really hard to guess what the value of a business is going to be 5 years in the future. And it's much safer to say, whatever the value of that business is in the future, I want a 20% discount off of it. So as an investor, I hate it when there's no discount rate, but I know it is becoming more common to skip the discount rate. But that depends on your investors and what you can get away with. And then valuation cap, of course, it says, hey, when I convert, there is a max on the valuation of the company when that conversion happens. And so the lower the valuation cap, the better it is for an investor because they basically get to buy into your company at a lower valuation. The higher the valuation cap, the better it is obviously for you as a founder because then you're doing that conversion at a higher valuation. So those are the main things to pay attention to on convertible notes and safes. And then equity, this is kind of the good old Shark Tank situation, right? How much of your money are you giving up? Make sure you're very clear about have I given up control or not? And how does that, future equity rounds impact your ownership stake? A mistake I see people make all the time is they forget that you usually don't just do this once. You often do it multiple times and you could get diluted multiple times. And so if you say, hey, I want a controlling stake in my company, so I'm definitely not going to sell more than 49% of my company. That sounds great. But if you sell 49% of your company and then you have to go raise money again, guess what? You no longer have a controlling stake because you now have nowhere to go if you are currently at 51% and you want to sell more equity. So just think about not just that dilution of this round, think about dilution of other rounds. And then lastly, across the board, I'd say something to think about is how much money do you actually have to raise? How much money do you have to raise? Because I see all the time people making the mistake of raising money because they heard that, oh, seed rounds are $1 million. I'll raise $1 million because that's what you're supposed to do with a seed round. No, you should raise how much money you need to raise to reach a certain milestone, so that then you can go raise more, or so that then you can then be profitable. Don't raise an amount of money because other people raise that amount, or because that's what you're supposed to do for a seed round. Excuse me. Raise an amount of money that allows you to get to your next milestone.
I'll let Alicia take a water break really quickly. I know that we're like coming up on our time, but this is so helpful. Caroline had asked you, Alicia, and I'll chime in too, just from like my tech perspective. Have you had experience using AI to read contracts for red flags? I'm curious to hear your take there, and then just, we're integrating AI into our experience, and so I've just been really deep in fine tuning the models and the prompts. So I'm definitely down to also share that perspective of like what to watch out for.
Yeah. So this is where AI should be really, really good. This is where AI will be really, really good. This is also where you have to be very careful right now on AI, because it's all about what is it trained on, right? So a very general AI throwing into Chat GPT and having it run through, and it's maybe been trained on a bunch of really bad contracts that are irrelevant for your business, is not going to be helpful. I mean, you can try it. I just, and maybe it at least is better than nothing. I'm not saying it's not better than nothing, but what I would say is I think this is where a year from now it's going to be really, really good, because there will begin to be AIs that are just focused on legal, just focused on startups, just focus, and I would be the first to pay for a service if I could find a good service a year from now that is trained on the right small business information, that then could read the contracts, and say, oh, red flag, look out here. I think it's going to be incredible. Right now, I think it's still very much early days. So I would just say, if you want to try it, go for it. It doesn't take much of your time to try it. And maybe it does flag some things for you. Like you come back and report to me and let me know. But I would just be, I would be skeptical right now, that it doesn't either give you some false positives or miss some negatives.
Yeah, I agree. I would say it's better than nothing. It's like input in, input out, right? So it will very much make up stuff sometimes. So like even
Yeah.
framing it of like the prompt being like, imagine you are a world-class lawyer that advises CPG startups on XYZ. Like uh, if you were to give your
Yep.
client, who is this category of a company, advice on negotiating a contract or reviewing a contract for blah, 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 with these main risks and concerns in mind, what would you think about this contract? Rather than just
Yep.
like, here's a contract, how would
Yep.
you, like,
A
what are the
hundred
red
percent.
flags? Yeah, it's like you really have to be very specific in the prompt that you give it, which is what like Alicia's mentioning, like why you might pay a service in the future because they've done all of that hard work for you.
Or
But
they
that
have the
would be,
database that
yeah,
it can be trained
that's
on,
been
that
key.
is really valuable. I mean, I think, like, for example, my concern right now, if you put Daintree's loan docs into Chat GPT, I should try it and see what it spits out. But my guess is it will at best be massively confused, because our loan docs don't look like anything else. So there's nothing it could be trained on that would help it understand what we're doing. And the places where we're different, they might see as red flags, but the places we're different are actually much more founder friendly terms. And so they might be like, ooh, warning, warning, there's no personal guarantee. And it's like, actually, no personal guarantee is a really good thing. So I would be careful. I'd be careful.
And then another question we have in the chat is it better to raise several rounds of smaller amounts to hit milestones? And what would that raise concern? And sorry, and would that raise concerns?
So yes, I think smaller rounds are better, with the caveat of I would never raise less money than at least 18 months runway. Because if you raise such small amounts that you're constantly in fundraising mode, you never get to focus on building the business. But I personally would rather raise money 18 months, 24 months at a time versus 3+ years worth of money. Because what happens is it's like a bag of potato chips. Once you open a bag of potato chips, who eats one potato chip and then closes up the bag and doesn't touch the rest? Money's even worse than that. Once that money's in the bank, guess what you do? You spend it all.
Spend it. Yep.
You spend it.
And Carta data shows that the average fundraise takes 27 months to close. So, like, obviously, it's a huge burden on the founder and it's a second full-time
Yep.
job. So,
Yep.
better raise it in a chunk so that you can kind of hopefully not raise it again, or like when
Uh,
it comes time to raising it, you've deployed that capital intelligently. Um,
100%.
any other questions? I know we're a little over. This has been so helpful, just like as a primer. I think, yeah,
One thing I'll just interrupt you
yeah,
to say, and we can send this deck out if it's
yes,
helpful to folks
absolutely.
afterwards. I do list out kind of some of the pros and
Perfect.
cons of each of these options just to kind of think about. And then I will tell you these, I'll leave you guys with this. These are some of the common mistakes I see founders making, first and
This is
foremost,
what I
like,
was going to ask, so this is
yeah,
perfect.
yeah. So first and foremost, you assume because all the press focuses on is venture capital, you assume it's the only option. And so you go down that path, even if your company is not a good fit for venture capital. Most companies aren't a good fit for venture capital, but everyone assumes it's the only path. Don't assume it's the only path. Figure out if all these other options and any of these other options could be a good path for you, because they may actually be a better way to build your business. The second point here gets to the question you just said, which is do not assume that bigger rounds are always better. First of all, by definition, a bigger round means you're raising more money at a lower valuation, because presumably if you did that same round in 2 steps, you'd have a higher valuation for the second part of it. And like I said, you tend to eat the whole bag of potato chips when it's in front of you. So don't assume that bigger is better, for sure. And then the third one is I really, really, really like to think about fundraising in terms of how much money do I need to get to XYZ milestone, and then give myself at least a 10, if not 20% cushion. Don't think of it in terms of dollar amounts. When people say, I need $1 million, I need to raise it, I'm like, oh, that's so convenient that it was like nice round number. How did you magically come up with this nice round number? I want to see the financial model that says, actually, what I need to get to this milestone is 1.1 million. And then I've added in another 150K as a cushion. So what I really need is 1.25 million. And here's how I got there. And here's what I'm going to be able to achieve with that money. And here's why that milestone is important. Usually that milestone is something significant that then allows you to raise the next round at a higher valuation. That's what you really want. I want to get to XYZ number of customers. I want to get to XYZ revenue. I want to get to XYZ product launches. Something very concrete that then makes your next fundraise easier or at a higher valuation. Don't reverse engineer for a round number. And then lastly, what I have up here is assuming that what worked for someone else is going to work for you. So much time we just like copy our friends and our buddies and copy what you see in the press, and every business, every founder, every geography, every product, it's all different, right? So don't assume that what worked for someone else is going to work for you. So sorry that we ran a little bit slower getting through this, but happy to
No,
take
this
more
was
questions if
perfect.
people have them.
Yeah. Does anyone else have any other questions? I think that was just a really love a good, like, don't, don't hop into this hot water moment. So that was really helpful. I think maybe one last question I have for you, if people don't have other questions, is what's like one founder finance habit you wish everyone adopted early?
Cash forecast. I think every founder should have a cash forecast that they are monitoring at least weekly. Because cash is king in startup land. And if you aren't clear about the likelihood that X revenues coming in from a cash perspective, not from a GAAP perspective,
Yep.
or that Y bills are going to hit, you've got to manage your cash well. So have a cash forecast that you are updating at least monthly. Sometimes even weekly is helpful. because it will help you make better decisions and it'll help you identify problems. Like, holy smokes, July is going to be the world's tightest cash month because we got to buy all that inventory for the, Christmas rush. And we've got the security deposit hitting for the new office space we're moving into, and such invoices that we're going to issue in June. I know those customers and they don't pay us till August. Holy smokes, July is going to be a problem. What do I need to do now in May to minimize my risk of that July pinch? What can I do? That would be a time when all of a sudden that short-term loan might come, like, what? In that scenario, let's not use the 3% for 30 days loan every single month of the year, but do I want to use it just in July to get through that pinch period? Maybe.
Yeah, that's really helpful and super good context. Well, thank you so much, Alicia. This was really informative. We will send a recording of this as well as Alicia's information so that you can get in touch with her if you have any questions or any interest in learning more about debt financing. And thank you to you all for your time today, too. I know you're super busy, but really appreciate it and hope to see you at the next founder event. We'll send out details shortly and a recording of this shortly as well. Everybody have a good rest of your day. See
Thanks,
ya.
guys. Take care.
Bye.